Hello investors, this is going to be our first video in this channel and it makes lot of sense if we take Intelligent Investor book summary written by Benjamin Graham, because till to the date this remains the Bible of investing. On the other side of the coin, this book is very big and then very vast. It's difficult to read for most of the investors. We are going to take up each chapter and then we are going to make a video for the each chapter. So this is going to be the video number 1 where we are going to talk about chapter 1 and the topic is investment versus speculation. This topic mainly speaks about the basics of investing and sets a ground rules for the remaining chapters. For reading purpose, we can divide this particular chapter into 3. The first is investment versus speculation, where the author talks about what is an investment, what is an speculation, and then whom we can call an investor. And the second part is who is a defensive investor. Author generically divide the investors into 2 groups. One is defensive investor, another one is aggressive or enterprising investors, depending on their risk appetite. So the second part of the chapter will be who is a defensive investor, how his portfolio looks, and third is who is aggressive or enterprising investor and what kind of stocks he will be holding. Firstly, in the start of this chapter, author will start with the definition of investment. So let us read it together now. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. So here, based on this definition, we have to take 3 key main points. One is safety of principal, second is adequate return, and third is mainly the thorough analysis. And then one more thing, author mentions about a word speculative. For every investor, we should know what is meant by a speculation. Mr. Graham says, whoever not fitting into his requirements, he called it as a speculators. For example, if you are buying a stock without analyzing the company, without understanding the business, then you are a speculator. Or if you are buying the business, you are understanding the business, but you are not doing anything on valuation, then also you are a speculator. And mainly in most of the cases, if people buy the stocks only because of the prices or expect the prices to go up without any background analysis, looking only for the profit, they are also called the speculators. Let us take the example of recent incident happened on GameStop. The people who are involved in this price hunt, mostly they are called as speculators as per author's definition. In this video, we will leave about the speculators. Now we can concentrate on the investors. Even if you want to be an investor, there will be a mild speculation that you have to do, because you are going to buy a stock based on your research that the company is going to improve in the future. That author calls it as an intelligent speculation. Now you would have understand what is meant by an intelligent speculation and an unintelligent speculation. As an investor, you have to make a thorough analysis of the past and present status of the company, and then you have to make an intelligent speculation on the future. This makes you an intelligent investor. This completes the first part of the video. Now we will go to the second part. Who is a defensive investor? A defensive investor comes under the category of investor who fits the description that we talked about now. The key point here is the defensive investor does not have any time to do the thorough analysis. So what he will do, he will limit himself to stable companies and stable investment options. The defensive investor will not invest in mid or small cap stocks. He will invest more in the large cap and stable companies if it comes to share market. Also, he will take up other options like a quality bond or quality mutual funds. So if you want to be an investor and you don't have any time, and if you are new to investing itself, you can start with this option. For our understanding purpose, let us look into a sample portfolio here. I have considered 3 major investment options apart from your savings and emergency funds. The first is high quality bonds, secondly mutual funds, and finally large cap companies in share market. Next we can go to the third part of the chapter, who is an aggressive investor. I hope now you would have got what author is trying to say here. An investor who fits into our category. Also, he has a time to do a thorough analysis of all the stocks. Also, he can take risk for the additional returns than defensive investor. Portfolio of the aggressive investor will not contain only the large cap or good quality bonds. Also, mid cap and small cap also plays a considerable amount in his portfolio. The main key difference between the aggressive investor and defensive investor here is the time as well as the amount of return that each person is expecting. Of course, the aggressive investor, he does a lot of analysis. He can expect a much higher returns than the defensive investor. For example, if the defensive investor expects a 12% annual return, the aggressive investor can approximately expect a 30 to 40% of return in a given period of time. Now let us try to understand why it takes much time for aggressive investor than defensive investor. If a company is fundamentally stable and it holds a great track record, then obviously the company will be so famous. The more people will be interested in buying the stock and of course as a result the price will be little much higher. As an aggressive investor, he has to analyze which company is not famous, also it is a fundamentally strong. So in that particular stock, if you could see the shareholding pattern of the company, the institutional investors or the portfolio investors, they will not have any percentage in that particular table. Only the promoters as well as a little amount of public will be having their shareholding. It is not an easy job, which is why the author is saying it will take considerable amount of time. Now let us look at a sample portfolio of aggressive investor. He may not invest in mutual funds or bonds. He will invest in large cap companies as well as mid cap and small cap companies. I want to highlight one point here that there will not be any fundamentally weak companies here. All the companies, either a defensive investor or an aggressive investor, they will buy a good fundamentally strong companies. So the key point here is, if you want to make a good amount of return as an aggressive investor, you have to buy a less famous fundamentally strong company, and then you have to wait for the institution or portfolio investors to buy your stock, and then the price will go up. Then you can make a good amount of return. So this is my first video. If you like my work, please subscribe to the channel and like the video so that this video will reach to more people. Thank you and happy investing.